Hello, thanks for joining us today. Today we're going to be looking at a review of 2023 and outlook into next year, 2024. So specifically, we're going to take a look at the main themes, and there was a lot in 2023 for the financial markets and our portfolios. Then we'll look at an update to our Traphagen alternative suite over the past 2 years and 4 years versus traditional investments to see how they fared. Then we're going to look at some specific examples as well that we're seeing now. And there really are a good amount of really unique and profitable investments at good returns with reasonable risk out there. So I wanted to go over some specific examples for you. We'll look at what we believe, and this is important, is what we believe is a new economic investment and really great regime. And this is a change that's occurring now. It started last year, beginning last year, continuing on. And this is really the first regime change we have seen since the Great Recession back in 08, 09, 2010. So it's been a long time, and we think we're changing again. And then lastly, we're going to see what investments we think benefit from this new regime, and then finally our outlook for 2024. So for 23, we could have picked many different topics, but we think these are 4 big ones. So first is interest rates are higher across the entire yield curve. So that means short-term rates, mid-term rates, longer-term rates are all higher, and some much so. At the same time, somewhat contradicting that is inflation. So inflation has come down, which is obviously a good thing from last year's levels. So we'll look at that. We'll also look at what made up the stock returns this year. So the S&P is up, as I make this video, roughly 13–14%. But that has been very concentrated in just a few stocks and really a historic concentration. So we'll look at that and where that came from. Earnings, was it multiple expansion, or what have you. And then lastly, we'll look at the phantom recession of 2023, which of course didn't happen, at least through Q3 23. We have had no recession. Despite many people, including ourselves, thought there was a heightened chance of a recession in 23, and that goes along with higher uncertainty. And really, in our opinion, this is one of the most uncertain periods we've also seen since the Great Recession of 08, 09. So we'll look at interest rates first. This top chart here basically goes through past 15 years or so, and it looks at the environment we've had for the 10-year Treasury yield, which is really the benchmark yield used for valuations, mortgage rates, a lot of things. So prior to the Great Financial Crisis, it was averaging 3.5% to 4.5%, pretty steady. Through the Great Financial Crisis, that dropped a lot for the next 12, 13 years, and it ranged usually between 1.5% and 2.5%, so much lower. And in fact, basically the lowest in history. And then over the past 2 years, we've seen a rapid increase in this rate. Right now, as we make this video, it's about 4.7%, 4.8%. So we're actually exceeding slightly the range even before the Great Recession, and that's why we think we are in this transition period of new regimes. So that's rates. On the bottom chart or slide, part of the slide, you see inflation, 2 different measures. The red is core inflation. So that's measuring all items minus the more volatile food and energy components. And then the blue line is looking at all items. So that would include everything. And as you can see, this goes back into 2018, about 5 years. And last year, inflation peaked somewhere between 6.6% and 8.9%, depending on how you look at it. Regardless, it's extreme levels of inflation. And then we have made significant improvement since then, which is obviously good. Somewhere in the upper 3s to low 4s, depending on how you look at it now. Very good trend. We think it's going to be tougher from this point forward to get to that Fed target, which is that green line at 2%. But we're in the right direction. We just think it's going to be a lot harder to get to that 2%. And the Fed has communicated that as well. But trend so far is good. Here we look at the S&P 500 return this year, and it's been very unique for a couple reasons. The main reason is, on the top chart is looking at the S&P top 7 stocks. So that green line you see, so far as I make the video, it's up just shy of 50%, would be just the stocks, the big tech stocks. So Apple, Meta, Nvidia, Google, Tesla, Microsoft, Amazon. They are up a lot if you take those out, strip those out, and you look at the S&P 493, the remainder of the stock market, it's up 2% or so. And if you just weight everything equally, it's down or about break even, 1% or about break even. So very historic bifurcation in the market. If you just broadly bought 100 different stocks in the market, you're probably about break even, give or take. It's really those top 7. All the returns really have been in those, which obviously has been very good this year. We'll see going forward if that's good or bad, but there is a concentration certainly in those stocks. And then on the bottom, where the source of these returns for those stocks have been has been mostly, not all, but mostly multiple expansion. So at the market bottom, we had, at least in the short term, last October, it bottomed at a valuation of about 15.5, fairly cheap. That has gone up to 18 times. So we see multiple expansion this year, partly because of inflation coming down, which makes sense. Earnings are about flat, so not really much of a change in corporate S&P earnings from 22 to 23. The returns we have seen are really from multiple expansion. We think that wanes in 24, and whatever returns we get from stocks in 24 will be earnings and dividend driven. So, when we look at this non-recession basically in 23, it's part of the uncertainty we look at. So I have a quote here that sort of summarizes that well, I think. We are navigating by the stars under cloudy skies, and Traphagen did not say this. I did not say this. This was actually said by Jerome Powell a couple of months ago. So when you have, one, if not the most powerful, important people in charge of, policy really in the world, acknowledging that it's a very uncertain environment out there, we take heed of that and we invest along those lines. So one way we can invest with that uncertainty in mind, and we have, is through the private alternative investments. They do not act in the same way and are not impacted in the same way as bonds or stocks or anything financial market related. So this is a chart going back 2 years, so late October 21 through late October a couple weeks ago. And all the colorful squiggly lines you see towards the bottom of this chart are traditional assets. So all different types of stocks, bonds, publicly traded real estate, things like that. And they're all negative. So the S&P is the best returner, but it's still down a couple percent, maybe 4 or 5%. And then US Treasuries, long-term Treasuries, normally regarded as the safe investment, quote unquote, down 35% or a little more. So it's really been a tough 2 years for almost all traditional investments as rates have come up a lot, and that's that uncertainty piece, even though we didn't get a recession. However, if you look at that dark black or blue line on top, that is our alternative suite put together. So all the different alternative and private investments we have as one suite. And as you could notice, a couple different things. One, obviously, the returns have been much better. So up more than 15% in this period, or about 7%, or a little over 7% per year annualized. 2, much less volatile than all the traditional assets, bonds included. And 3, no correlation. So you could see on the left side, the drawdown from top to bottom on all the traditional assets, 20-25%, which is of course significant. The biggest drawdown we've had on our alternatives was only 2.7%, and that was because of Hurricane Ian last year. Nothing to do with rates, the economy, or anything else. So we're very, very pleased about the protection and actually some offense we played with these alternatives as well, with the 15% return. And then that's 2 years. If you go 4 years back, you see a similar pattern, where again, all the colorful squiggly lines are all traditional assets. So you saw the crash on the left side in COVID, a recovery of many of these through the bull market in the rest of 2020 and 21, and then we've had the bear market. And what you'll notice again is good performance. So the alternative suite in this period was a little over 30%. And, this is a period of 4 years. So, 6-7% or so per year annualizing out. Very steady return, low volatility, and again, no correlation. Really, no matter what all these other asset classes are doing, up, down, sideways, it doesn't really matter. The alternative suite just does its own thing. And we continue to hold for clients, somewhere between, for most clients, 25 to 35% of their portfolios in these alternatives. And we're quite proud of the fact that over the course of this period, we've saved about 160 million in client assets through the use of these alternatives rather than just a traditional portfolio. So that's a big number, and we're proud of it. And then as an example of one of these, there's the insurance securities. This is one of the better performers this year. And this chart basically goes through past 30 years or so to 1990. And the blue line, you could think of this blue line as the premiums we are making per unit of risk. And again, insurance securities, for those who need a refresher on this, this is basically you're in the same seat as an insurance company. We make money by premiums coming in from the insured property casualty on their house or boat or car. And then if there's a large damaging hurricane or earthquake, we would pay money out or lose money. So all else being equal, we want to invest in these things when premiums are at their highest, when premiums are up a lot. And that's where we were and still are in 2023 and as we enter 2024. And you get two components of return here. One is from, until we know the outcome of these contracts, they sit in cash or T-bills. So they get 5.4% yield on the T-bill currently. And then the premium spread on top of that is right now 9.5% approximately. Minus off the average fee of the funds, we're getting an anticipated yield of 13 to 14% net, with the added benefit of no credit, economic, or interest rate risk to principal, which is very rare to find. And has this actually worked this year? Yes. So we have two main funds we hold here. Pioneer's Fund is up 16% year to date, net of all fees. Stone Ridge is up 19%, net of all fees. So we're very pleased with this, and we maintain about a 7.5 to 10% allocation to insurance securities. And it's not just the insurance securities that we're seeing a lot of opportunity. It's also in private credit and other alternatives. So these are some examples of, on the private credit side, specific deals that we're seeing within the funds that we invest in for our clients. So the top two are related to litigation finance, and that's lending money normally to an entity or an attorney's firm or something similar to that. And we give the cash up front to them. In exchange, we get rights to a legal settlement. I won't get into the details, but I did highlight the return profile that we're seeing on this. And this top one is a fixed rate of 12%, plus the opportunity for some profit participation, obviously quite attractive. And the bottom one, we have SOFR, which is the risk-free rate, so call it 5 or a little 5%, plus 9.25, so it'll floating rate. And plus we get a 1% fee from the borrower right up front. So these are quite attractive, and they're not tied to the economic cycle at all. So we really do like that aspect. On the bottom, this is a new strategy we're looking at, and this would be infrastructure credit. So these are more examples here: data center, fiber, battery storage, power generation, and these all have yields of, call it 10 to 13%. So when we see all these different yields and opportunities of, call it 9 to 13%, some of them floating, some of them fixed, they're all on unique, more stable assets with historically low defaults. We do like that a great deal. And then continuing with going through this transition of regimes and uncertainty, the way we're looking at this is we want to guardrail portfolios for two scenarios. One is if we cool off too much and we do get the lower inflation, but it comes with maybe a recession, much lower rates, lower growth, things like that. What we want to have in the portfolio, and we do, are mid to long-term treasury bonds. We want quality tech, growth, utility stocks, and for risk-tolerant clients, Bitcoin. We want those assets in there in case we get a significant cooling where rates would come down a lot and growth would come down. If we get the opposite and we get a much hotter economy, so that would be higher or stickier inflation, higher rates, higher growth, we want value, we want companies with low amounts of debt, we want high free cash flow stocks, healthcare companies, energy pipelines, infrastructure. All that would tend to do well in that type of environment. And then in the middle, the insurance securities we talked about, the private credit, and then short-term T-bills, those would tend to do fine regardless. So right now, for most clients, we hold all of these things in different allocations, guardrailing. And if we see us start to tilt one way or the other, then we'll make the changes therein. But right now, we are guardrailed to protect on either side. And then this gets into the specifics of the regime change we're seeing. So from 09 to 21, we saw very low rates across the board. So low inflation, mortgages, savings, all low, very low rates, near zero for most. We saw abundant energy, credit, labor, favorable geopolitical trends. And if a company is making a certain amount of money, a greater percentage of that profit went to stockholders because the debt cost was very low and extremely accommodative Fed policy. They were helping us basically, or helping assets. Now, starting last year and forward, basically it's the opposite of each one of these things. So much higher rates, higher inflation, more volatile, labor and energy, credit constraints, geopolitical issues, of course, with Russia, the Middle East, China, deglobalization or pulling back of supply chains. And all these things are sort of reversing, and to some a pretty large degree. And that's why we are looking for investments we think have the opportunity to outperform, and that's what BVs. So we went over, diversified private credit. If we could get net yields in the 9 to 11% range on the credit side, we will take that. So we do have a large allocation to private credit. Infrastructure on the debt and equity side. So we want to be on the equity side, owning the actual assets. And there we think we get 4% or so yield and maybe another 5 or 6 on top of that for growth. And on the debt side, again, 9 to 11% yields are possible there. Insurance securities doesn't have anything to do with the economy, and favorable yields of 12 to 14% net. And these are on the alternative side. On the traditional side, we see opportunities, again, if you have a company with high free cash flows, good profits, low debt, they could do fine. Treasury bonds, you have to be careful of where you go with treasury bonds. But still, now that they have come down in price, up in yield a lot, we think there's good opportunity there. And finally, healthcare consumer stocks. We think these are defensive. We think there is a value. They produce good cash flows and profits. And even if we get a recession, those tend to hold in pretty good. And then, some clients have been inquiring as to why don't we just put everything into, 4.5 to 5.5% CDs or savings. There's nothing wrong with that for certainly a portion of your portfolio or your assets, your emergency fund, what have you. But the reason we don't go all in or a significant amount is this. So we went back and we did look at 6 different hiking regimes. And we isolated the point where if you could time the exact peak of the CD rate. So if you could have timed it perfectly and said, let me get the highest CD rate, what yield did you get on that CD versus what did other assets do 12 months thereafter? So when you look at 1984, for example, that's that cycle, for example, CDs, if you timed it perfectly, you got just over 10% yield on a CD. Great. However, all other assets did better over the next 12 months. So stocks, bonds, both high quality and high yield bonds did 20 to 30%. Same idea in 1994. If you were able to lock in a 5 or 6% CD, you locked it in, but you gave up 20 to 30% or 40% on stocks and bonds. And except for a few exceptions, every cycle has been the same. So you do want to be careful with that temptation. And then to wrap up here, looking forward to 2024, these are the main pieces that are issues that we look at. So certainly there's going to be tighter credit. We think the consumer will be more constrained as student loans come back, as just rates are higher for mortgages, car loans, and durable goods, and things like that take a lot of money to purchase. And it goes to some extent to corporations as well. So we think that's a likely negative. Stock valuations, not too concerning. They might be a little bit or somewhat overvalued relative to average, but nothing too concerning at all. U.S. election, definitely going to be, most likely at least, an abnormal election, if you will, unique election cycle, maybe certainly more polarized than we're used to or want. But it will happen and it will be over at the end of next year. So here, with the combination of historically election years are quite good for the stock market. So when we look back on all presidential election years, they've been quite good. And 2, once we get this over with in November of 24, towards the end of the year, that should be a positive, just to have that certainty. Then we would look at Fed and global central bank policy. That has been a negative in 22 and 23. We think that's neutral or maybe even a slight positive as we hit 24. Inflation trends has been a positive. We think that continues to be a positive. as maybe it'll be slower to come down, but we still think it does come down further. And then no question, since we're just starting off with higher returns on bonds and alternatives, we think that is certainly a positive. And then lastly, interest rates, stabilize, gradually become less volatile, and therefore we do think it'll be really the first positive year or good year for bonds since 2020. So it's been 3 years since we had a positive year in bonds. We think we're finally there after a historic downturn. So that'll be a nice boost to portfolios, hopefully. We think a slowdown recession is possible, and it's still the chances elevated versus normal. However, that could be priced into some stocks already, especially in the 493. So if you take out the top 7 big tech stocks, the stock market is a much more reasonable, call it 15.5 to 16.5 versus the 18 or 19 if you include them. So we think if you go underneath the surface, a lot of stocks are already pricing in a slowdown or a recession. And then last, we obviously discussed, whenever you change regimes or there's a lot of change going on. There's always opportunities as well. And that's what we see in private credit, infrastructure, high quality bonds, insurance securities, even some parts of real estate, data centers, industrial warehouse, residential, and some sectors of the stock market that we talked about. So that's a summary of where we're thinking 24 is headed. Thanks for joining us. Any questions, let me know. Eric at ERIC@tfgllc.com or contact your Traphagen advisor. Thanks for joining. Bye-bye.